this presentation I'm giving, we've titled Reserve Studies 101. And I will tell you, if you're interested, I do a few more advanced presentations in terms of reserves, in terms of adequacy and how to review your study and things like that. But this one is meant to be a basic seminar on reserves. But if you have any questions or comments, like I said, please feel free to jump in and don't be shy. So I'm going to be talking about, let's start at the beginning, which you'll see this is the beginning. So, and also what is reserve study? And then the biggest question that comes up to us is, once you get a reserve study, what does adequate mean? So when you get a study, I mean, what you're looking for is to make sure that your community is adequately funded. And as you'll see when I go through this, you could have two communities exactly the same right next to each other, and your definition of adequate is different. And why is it different? Because you have two different groups who head up the board, and the definition for them of adequacy is different. So it'll be different even if the community is the same. So I'm going to spend a couple minutes talking about how do you come to a decision in terms of what's adequate for your community. So starting from the beginning, when you have a community or anything that's built, it starts out where you design it. You have the architects and the engineers that design it. If you build it, then after it's built, what do you have to do? You have to maintain it, and when things wear out, you have to replace them. So when you look at this globally from the life cycle standpoint of a community, you see that construction and design, I mean, can you see my pointer when I move this thing around? I think you can, right? Okay, when you have a community, about 30-something% of it is before you guys even move into it or manage them. But operations, maintenance, and replacements take up 60-something% of the operational costs over the lifetime of the association. And that's what you're involved with, is replacements, maintenance, and operations, which is the beginning. How do we get here? So the question comes up, when it's time to replace your roof, where does the money come from? And that's what it's all about. I mean, it's not just roofs, but just you'll see I use roofs as a pretty common example throughout the presentation. So what is the reserve study? A reserve study is a budget planning tool that establishes a stable and equitable funding plan to offset anticipated major future repairs and replacements. Now, a couple of things I want to point out as far as what a reserve study is. First, it says it's a budget planning tool. If you think you're going to get a reserve study that's going to tell you exactly how much it's going to cost to replace your roof 10 years from now, it's not going to happen. It's a budget planning tool, so you're setting aside enough money, but you know, it will never match exactly how much it's going to cost you. It will be close, it should be close, but it'll never match. So it's a budget planning tool, and the funding plan is the key to this whole thing. What is the funding plan for your community? And you'll see that originally, years and years ago, when people did reserve studies, a lot of times they didn't do a funding plan. And you look at it now because it's in the national standards and said, how do you come up with a plan to replace these things unless you have a funding plan? So, but that's what a reserve study is. It includes two parts. It includes the physical analysis and the financial analysis. Now, the physical analysis is the basis for the study. But it's kind of interesting as I go through this, remember that before we had the national standards, most people across the country, when they did reserve studies, only did the physical analysis. They did not do the financial analysis. As you'll see, and I think you'll agree, the question is, how do you do a reserve study and come up with a plan if you don't do a financial analysis? But so it's a physical analysis, which is broken down into three parts: the component inventory, the condition assessment, the life and valuation estimates, and I'll talk about each of these in a little more detail, and the financial analysis, the fund status. And the fund status, don't be fooled, and I'll talk about it, it's just a guide. It really doesn't give you a lot of information, but it's a status, and I'll show you what it means, and the funding plan. The key to making the study correct is the component inventory, and the key to coming up with a plan that works is the funding plan. But the funding plan is the key to having a set aside adequate funding. It's the funding plan. But this is what it's include. Now, the physical analysis, it looks like this. Now, it may not look exactly like this in your reserve studies, but it should have this same information if the study is done in conformance with the national standards. And you'll see that I've broken down on the bottom. A physical analysis includes component inventory, life and valuation estimate, and condition assessment. So it all comes together. It's really just math. And I'm going to start and go from left to right. Left is the component inventory. What makes up your common elements that you will need to be replacing? And a couple of key things to remember, and you'll see that I do repeat myself, is that the component inventory is based on your common elements and your limited common elements in your community. Now, if any of these, I'm assuming from that, if you're on this webinar, that you understand some of these in the industry terminology in terms of what is a common element, what is a limited common element. But the components are made up of common elements that will require replacement within 30 years of when a study is done. So if we do a study today, then those components should include all of the common elements in your community in the next 30 years that will require replacement. Very important point to remember, and I'll say it a few times, and the reason I say that is because as communities get older, that 30-year window, I call it, moves out. So when the reserve study is initially done, it goes out 30 years from original construction. Now your community is 10 years old. Now it's going out 40 years. So if you have a component with a useful life of 35 years, initially it's probably not going to be in the study, but now you're 5 years old, it should be added to the study. Very important point, and I'll mention it a few times, because when you get updates done, you know, it's very important that you have whoever's doing your update check to see if anything should be added. So the components here, just as an example, pavement, seal coating, pavement, concrete walkways, all kinds of things. Now, I'm going to touch on statutory requirements a little later, but I know there are a couple of people here from Florida. When you select the components, it's based on the common elements, and in some places there are statutory requirements of things that need to be included also, which typically they fall within this criteria, but there's also other criteria that you may base it on other than just the common elements. For example, I'll touch on what the Florida statutes say in regards to what should be included. Those people that are in the Northeast, there's a number of people here from New Jersey. In New Jersey, there are no statutory requirements. There are plenty of guidelines, but there's no statutory requirements. In Pennsylvania, there's no statutory requirements, but there are a number of states that have statutory requirements of what should be included. Florida is one of them, California is another one. There's a number of states that do have it. So that's the component. What is the component? And I say this all the time. You can get the entire study right, but it can be wrong if you don't have the components right. So if you leave out a roof, everything is going to be based on a community without a roof. So the study can be right, but it's totally wrong. So the component inventory is really the key to the study. It's like the foundation of a reserve study. What are the components? Second column is quantity. You have the components. How much of it is there? So for example, I'll use the roof isn't on here, so I can't use an example, but another common one is pavement. Here you have 28,797 square yards of pavement. How do you get that quantity? One of two ways. You either go out and measure it, or you have the drawings of the community and you measure it based on the drawings. Now, one of the questions that comes out a lot in a webinar like this is, how much does a reserve study cost? Let me ask you a question. Is it going to cost more if you take it off the drawings or if you have to go out and measure everything? Obviously, it's going to cost more if you have to go measure everything. So, but that's how you come up with the quantities. So I will tell you also these days, we do a fair amount of stuff with drones. If you do drones, you can actually measure it based on doing a drone overview of the community. But the least expensive way to do it is to have a set of, for example, for the pavement, have a set of the site plans, the engineering drawings that show the roads. Then we can measure them in the office. For example, we use a program called On-Screen Takeoff, where we can digitally scan those drawings and then trace the roads, and it will tell you the quantity just by tracing them using the software. There is, I'll also put a little asterisk on this. It's very rare, if ever, that a community is built exactly the way the drawings show it. So when a reserve study is done, if you use the drawings, one of the things that should be done is when you're out doing your inspection to make sure that it matches essentially what the drawings show, and if it doesn't, to make adjustments. But that's where the quantities come from. The next is how much will it cost to replace it? The unit cost, for example, the pavement overlay, 28,797 square yards, $21.66 per square yard to replace that road. Or to not, in this case, you're not actually replacing the whole road, but it's $21.66. What does that include? Very important. It's not only the cost of putting in something new, but it's also the cost of removing what's there already. A lot of times the cost of removing it is more than the cost of putting it in. I always use the sidewalk example. A sidewalk to put it in new by a developer may cost $5 a square foot. When it's time for the association to replace that sidewalk because it's cracked and it's time to be replaced, it may cost $6 or $7 a square foot to take it out and $5 to put it in. So it's critical that you include the removal cost as well as the replacement cost or the new cost. So for example, when you take pavement overlay, what that means is your pavement is typically, let's say 6 inches thick. It's 4 inches of what's called the base course and 2 inches of what's called the top course that are put in and glued together. The top course has less stone in it, so it's smoother, so you drive on it. But what usually happens is when you do a pavement overlay is you mill off the top 2 inches and you put down a new 2 inches. So that's how pavement is typically done. So you see you are removing as well as putting in new, but you have to keep into account both of them. Now, reserve requirement, present dollars, very simple. It's math. What quantity times unit cost, how much is it going to cost to replace it? Pretty simple math. Now we get into what's your beginning balance. For example, if you go bottom of this column, this association has already set aside $280,212 into the reserve fund. It's very rare that as communities get older, they have nothing there, although it's happened. But associations are collecting money. So in this case, they have $280,000. Then this beginning balance is this amount of money is just distributed to each of the components based on how old they are, how much of the overall list they make up. So for example, in the top one, it says beginning balance attributed to this is 0. You know why? Because there's a 20-year life and it was just replaced. So there's no money set aside for it yet. But every one of these other ones, for example, pavement seal coating, it has a 5-year life, 2 years left. So there's money set aside for it. So then you have the beginning balance. Then you have the estimated useful life. What's the full life? And by the way, let me jump back. The question, where does these unit costs come from? We use a combination of 2 things. There are a lot of national estimating standards. For example, RS means is one we commonly use. And then we also use actual contractor costs because we're involved in a number of, for example, paving projects, roofing projects. So we know how much the actual costs are. So that's where these unit costs come from. And clearly they have to be adjusted based on a geographic factor depending where a community is. For example, if you're in Florida, you have a different geographic adjustment factor than you do if you're in New Jersey. So then you have estimated useful life, estimated remaining life, annual reserve funding required. Here's the math again. Annual reserve funding requirement, you take how much does it cost to replace it? Subtract from that how much you've set aside already, okay? And then it says if it has 5 years life or 2 years life, whatever you need to accumulate then is divided based on how many years left you have before you have to replace it. So using the pavement seal coating, it's $47,000 total replacement cost. You've already set aside 13. So 47 minus 13 is 34,000. And there's 2 years left before you have to do it. So 34,000 divided by 2 years comes out to $17,000 a year. Very easy. It's all math in this physical analysis. This full funding balance means essentially, and that's part of the presentation. Well, I'll tell you now, because we're there. If you have a component, $100,000 replacement cost and a 10-year life, how much should you be setting aside a year? Nobody wants to answer? Everybody's staying on mute. 100,000 divided by 10 years means $10,000 a year. So after 3 years, you should have set aside 3 times 10,000 is $30,000. But if you've only set aside 15 instead of 30,000, that means you're 50% funded. And this full funding balance category shows you if you were fully funding using that example, every one of the components, you should have set aside $607,000 already. Now the question comes up because I know you're all thinking it. You should have set aside 607. You've only set aside 280. You've only set aside half of that amount. I'll talk about that later when we talk about adequacy, but do not be fooled. I'm going to say it a few times. The full funding balance typically is more than you need. And I'll make that argument all the time that it's always more than you need and that somewhere lower than that is what you need. That's where we're talking about adequate funding and funding plans. But does anybody have any questions about the physical analysis? Feel free to jump in, no? All right. You guys are very quiet. All right. So that's a physical analysis. How do you come up with the components? I'm going to go through this pretty quick because we've talked about it. The components is the most critical part of the study. First thing is review the governing documents for the definition of common elements and review your statutory requirements if there are any. Step two, is it covered under a maintenance contract? I'll give you two examples, an elevator in a building, because I don't know what kind of buildings you guys have, an elevator in a building or a lawn sprinkler system. In most instances, those things are covered under a maintenance contract that your community has. If it has a maintenance contract, that maintenance contract may include replacing parts of those systems. So you don't want to fund for any of these things twice. So you need to really check maintenance contracts to see if a maintenance contract will cover the replacement of any of the components. So for example, when we do a reserve study, a reserve update, which I'll talk about the different things, we always ask to see copies of any of the maintenance contracts you have to make sure you're not double budgeting for something. So maintenance contracts are very important. You don't want to double fund for something. All right, is it covered in another part of the budget? Another example, sidewalks. In your community, if you have sidewalks, and let's say one section of the sidewalk has a problem, where do you take the money from to replace it? You probably take it from your operating budget. You don't, even though you're setting aside reserve money. The point here is just because the sidewalks have a 30-year life doesn't mean some of the sidewalks will need to be replaced in 10 years and some will need to be replaced in 40 years. If you have to replace something that the component is on your reserve study, take the money from your reserve study. Don't do it out of your operating budget. Make sure you're not taking from someplace when you're already funding it. In the example of sidewalks, what some communities say is that we take money on an ongoing basis for small sections of sidewalks out of our operating budget. Well, then don't have the person who prepares your reserve study include 100% of the replacement cost of the sidewalks. Only make it 50% or 25%. But the key is you don't want to budget for it in two places, so you're funding for it twice. A piece of mechanical equipment, if it has moving parts, it will need replacement. So it's a piece of mechanical equipment, it should be in the reserve study. That component should be there. Is the useful life within the selected time window? This goes back to the 30-year projection I was talking about. If it falls within that 30-year period from when you're doing the study to 30 years in the future, and it meets the other criteria, it should be in the reserve study. Step 6, is it below the operating budget threshold? Let's say you have a clubhouse where you have a toaster oven that costs $30 to replace. It's a common element. Should you put that on your reserve study? What most communities do not do that. They just say, if we have to replace the toaster oven, we'll take it out of operating budget. But some associations say to us, anything with a replacement cost less than this amount, don't put it on the reserve study. We'll take it out of our operating budget. So that's what I mean by the operating budget threshold. So keep that in mind also. Let's see, where's that arrow? All right, 7. This is what I mentioned. Is it covered under statutory requirements? I touched on that. This is what it says in Florida. Reserve studies must include, but are not limited to, roof replacements, building painting, and pavement resurfacing, regardless of the amount of deferred maintenance expense or replacement cost. They have to be included, and any item that has a deferred maintenance or replacement cost that exceeds $10,000. That's what the Florida statutory requirements are. It's a little bit confusing, and the reason not confusing, but it's really not, doesn't match 100% what a reserve study is, because reserve study is meant for replacement of components. Here they're talking about painting. Most people categorize painting as maintenance, not replacement. So in most places, painting is included in a maintenance schedule, not in a reserve schedule. But in Florida, this is what the statutory requirement is. And Gene, we just talked about that the other day. It's roof, building, pavement, and anything with a replacement cost of over $10,000. Very, I guess, kind of not vague, but that's what that statutory requirements are. I would say, for example, in California, the California Real Estate Guide is a book that gives the entire list of everything that has to be included. It tells you what the useful lives are, and if I'm not mistaken, it also tells you what replacement costs to use. But there are some states that have statutory requirements. All right, so now I'm going to talk about the financial analysis. Again, it's made up with the fund status, percent funded, and selecting the funding plan. Now, I already talked about what the fund status is. It's that percentage. But the funding plan is your plan to provide income to offset future replacements. I mean, that's pretty straightforward what that is. And there are a number of different choices. Most of these choices you don't want. The first is periodic assessments over the life of the asset. $100,000 asset, 10-year life, you should set aside $10,000 a year. That's a periodic assessment over the life of the asset. Special assessments. You don't set aside enough money and it comes time to replace, you don't have enough money. So you have to have a special assessment, go to each of the unit owners and say, you have to come up with money because we need to replace the roofs that are leaking. The other is borrowing. Borrow from a bank when you don't have enough money, or combinations of the above. So you may have enough in your reserve fund to do it, but not the full amount, and you need to borrow or special assess. So these are the choices. All of the funding plans I'm talking about are based on periodic uniform assessments over the life of the asset. I have never seen one, and we would never do a reserve study that says only collect this amount and you're not going to have enough for special assess when you get to this point. It's not the intent of a reserve study. That happens if you don't fund properly, but they're all based on periodic uniform assessments. The advantage, make sure the funds will be available, reduces the likelihood of special assessments or borrowing. The key thing here, which I should actually move it to the top of the list, is it charges current rather than future owners. And let me give you my classic example of a roof. A roof has a 20-year life, let's say. You don't set aside money. Somebody lives there for 19 years. Year 20, they move out. Somebody else moves in. It's time to replace the roof. So what happens? The person who just moved in is paying for a roof that somebody else lived under for 19 years. Charges current rather than future owners. That's not right. It's not right. So one of the things is, by having reserve, the people that live there are paying for things as they're using them, and it's not being forced onto somebody in the future who never lived there. So that, to me, that's the real critical advantage of periodic assessments, is charges current rather than future owners for the replacement. Anybody have any questions about that? Because now we're going to step into funding plans. All right, there's actually 5 funding plans, and I'll tell you what the last one is. But there's 4. There's types of studies. All right, the first one is full proportional funding. If you look in the standards, this is called full funding. I put it here as / proportional funding. I really think on a national basis, we should change the name from full to full / proportional. The reason I say that is because when you look at and you see full funding, you already immediately come to the conclusion that if I'm not fully funding, I don't have enough money. I'm going to show you that full funding to me is overfunding. It's to you also, it's overfunding. But one funding plan is called full funding, which means overfunding. Next is baseline funding, which I'll show you, threshold funding, statutory funding, which I touched on. Now, the best way for me to explain to you what they are is, I'm going to jump to here, is to show you a graph. This graph shows you're starting, in this case, in 2004, and you're accumulating money as you go into the future. Wherever the line drops down, that means you're doing a replacement. So this is your funding plan alternatives. The top line is full funding, the bottom line is baseline funding, and the middle line is threshold funding. Let me explain to you what the differences are between the 3. Top line full funding means taking the roof, 100,000 divided by 10 is $10,000 a year. You take every one of your components and you figure out how much you need fully for every one of them and add it together. It's also called the component method, because each individual component is standing on its own and you're adding them all together. What's the problem with full funding? See, if I do these live, then I make the audience answer, but I can't make you answer. So the problem with full funding is, if you follow this cash flow projection into the future, here's the low point right here. At that low point, you have a significant amount of money in your account, which could be millions of dollars. So if you're running a business and you look at a cash flow projection, would you let millions of dollars sit there forever and really not use it? The reason you have that is because you're adding together all the different components. They have different replacement costs, different useful lives. So what happens by doing that, you're always going to have a fair amount of money sitting there. So what do? You say, okay, let's take, if my annual contribution is $100 a year to have this amount, what happens if I lower my annual contributions? Let's lower it to $25 a year. What happens? This low point drops down and it goes all the way to 0. That's called baseline funding, where you reduce your annual contributions so that you'll always have the money, but it goes down to the low point of $0. It is the most risky thing to do. I do not recommend that you do it. And it's called baseline funding, because what happens? Let's say this component, they have to replace it this year, costs $10 more than you anticipated. You're going to run into a deficit. Let's say that this component has to be replaced a year earlier. It's going to go into a negative. You're going to run into a deficit. So I will tell you, to me, and I think to you, full funding is overfunding. Baseline funding is underfunding. And where most communities are is somewhere in between these two, and their threshold funding. So threshold funding is my recommendation for most communities, what they should do. Keep in mind, you can go from full funding, threshold funding, baseline funding. You can switch it every day if you want to, but these are the different models. And the question becomes down here, the threshold funding is hard to see because it's in yellow, but threshold funding has a low point right here. Full funding is here. Baseline is down here, 0. The question for adequacy for your community is, what do you make your threshold? So do you feel comfortable and adequate if it's at baseline? I would doubt it. Do you feel comfortable and adequate if it's at full funding? You should, but you're setting aside more money than you need to. So what do you set your threshold out to determine your adequacy? Does anybody have any questions about the funding plans? Because, this is the most important part of this study to me. And the other thing is, like, when we do a study, we show another line here, which really answers the question for everybody. When we do a study, we have a red line in here, and it shows what happens if you continue to fund the way you are now. And as soon as you see this red line going into the future and it drops below 0, you know that you're underfunding if you continue to fund the way you are now. So this doesn't show it, but when you have a reserve study done by somebody for you, one of the questions is, how do you ask for a reserve study? Which I could talk about if you want to know, but I would say one of the things you should ask for is, when you do your cash flow projections in your funding plans, show a graph that shows baseline funding, shows full funding, and shows what happens if you continue to fund the way you are now, because that one graph will answer the entire question for you in terms of whether or not you're adequately funding. Keep in mind also, for threshold funding, it is not a decision that the reserve provider can answer for you. It has to be a discussion. You have to have a meeting with whoever's doing your reserve study to come up with what is adequate funding for you in order to come up with what that threshold should be. Is everybody with me so far? Anybody? The people that aren't showing their faces, I hope you're not sleeping, but the people, the faces I can see, you look awake. So, but this is the key. And for managers, I don't know how many managers are on this and how many board members are on this or whatever, but for managers, understanding this concept and being able to go to your boards and explain it adds so much value to you as a manager, because you understand what this means and how you can get to adequate funding and why you need to have a discussion about it rather than just accepting a report. So I jump around a little bit. When you get a reserve study report, you should not just take it and say, I can use it or not use it. You have to have a discussion with the person who prepared it to come up with adequate funding for you. All right, the fund status, now you can see why. If you, again, have a roof, $10,000, in this case, up to 20 year, $5,000 a year, if you're setting aside 50% of that amount, you can see pretty clearly why up here, this is 100%. This may be 20%. This may be 50%, but assuming that you have to have 100% is overfunding. And that's why when you do this fund status, the percentage, it's only a guideline, but it's not the answer. And I think sometimes people look at it and say, without understanding, coming to a webinar like this, say if it's not 100% funded, it's not enough. But this is the key to why it's more than enough, because it's kind of deceptive. It's used as a guide, but it's not the answer, that's for sure. So where do the requirements for reserve studies come from? A board's fiduciary responsibility, associations' governing documents. I mean, some people have said that their governing documents include a requirement to do a reserve study. I'll be honest with you, I've never seen that. I will, as you know, that when you move into a community, the governing documents that the developer sets up includes reserves in the initial budget. So sometimes it's in the governing documents, but I've never seen it as a requirement. Statutory requirements, we talked about that, and industry practice. Most the communities we deal with understand why they should do reserve studies, but they're, these are the requirements if there are no statutory requirements. What are the standards? These are the National Reserve Study standards, what they look like. If you go onto the CAI national website, you can download these. And what we generally do is at an end of a webinar like this, we'll send you a copy of the National Reserve Study standards, and we'll send you a copy of the best practices paper. This is that famous book, Reserve Funds, How Why Community Associations Invest Assets. And you can see that I'm one of the authors of the book. But that's a book on reserves. The American Institute of Certified Public Accountants used to publish a CIRA guide, a Common Interest Realty Association guide. Chapter 3 was all about reserves. Now I think you can get it as an electronic copy, but they don't actually sell the book. And Chapter 3, Future Major Repairs and Replacements, was all about reserve studies, and it referred to the CAI national standards as the standard for putting together a reserve study. So now the key, everybody understands the funding plans, the full threshold and baseline. So how do you decide if you're adequately funded? What does that mean? How do you decide where to set your threshold? That's what adequate funding means. So how to decide, and it's how to have a discussion about what you're going to do. Again, adequate funding is, to me, theoretically, if over 30 years it doesn't drop below zero, you're adequately funded. The question is how much risk you want to take, and that's how you stop. I'm sorry?
We do have a question. Can you comment on the shelf life of a reserve study?
The shelf life. I've never heard it put that way. Sure, and thank you, because I can't see the chats. So thanks, Jen. You're talking about the updating frequency. I'll get to that.
I would think that's what it, yeah.
Yeah, it's a great question. How often should you update? And I do have, and if you're interested, maybe we'll do it, another webinar on reserves that's a little more in detail about this in terms of for your community and what you do, how to select an updating frequency and what type of study to do. But I do touch on it in a few minutes. But so thanks. All right, so adequate funding. How do you decide what's adequate funding for you? And like I said, every community is different and a lot of them are the same, very similar. But you base it on the size of your budget. For example, if you have a $10 million budget, and let's say your reserves make up, a lot of times, by the way, they can make up 30 to 60% of your budget. So it could be a lot of money. And so size your budget. You may say that in my budget, if we have something that's $100,000 and we don't have enough money, we'll take it out of our budget, our operating budget. So it's based on looking at a few things: the size of your budget, the cash flow projections, which I just showed you, looking at the full funding, looking at the baseline funding, and look at how you're currently funding, amount of risk you want to take. For example, if you don't have a problem with risk, why not use baseline funding? Because baseline funding can save you a lot of money, even though it's very risky. So maybe you'll take that kind of risk. I also have given seminars on this with, we did one a number of years ago called The Great Debate. Full funding versus threshold funding. And I was the debater having to do with threshold. And I don't know if you know Robert Norland from California, but Robert was the full funding. And we had this discussion. And I made the argument that baseline funding is perfect. Update your study every single year. It'll cost you a couple $1,000s to update it. But then baseline works. And on top of that, even though the study costs you $2,000 every year to update, you're going to save $30,000 in reserves. So you take a look at the amount of risk, how often you update, and the cost of the most expensive component. For example, if you look at the cash flow, let's say the most expensive thing you ever have to replace is $50,000. You may say, I want to set my threshold so it's $50,000. So in no place over the next 30 years, if the most expensive thing goes, I will always have enough money to do it. That one may be one way you look at it. What's the cost of the most expensive component? But then keep in mind, what if two expensive components go in the same year? So you have to take a look at all these different things. So I hate to tell you, I'm showing you how to evaluate it, but there's really no answer to it. You have to come up with the answer. That's why it's important to meet with the reserve preparer. Again, adequate funding does not mean full funding, it means overfunding. So again, it's what threshold you use. And I think these are some of these, this is a repetitive slide, I guess. I talked about this. full funding, adequate funding, how often you should update. So I was jumping ahead because of the question that came up. So first of all, you should be looking at your reserve study every year as a planning tool. For example, take a look at it. Your manager should take a look at it, or the board should take a look at it. Look, what is anticipated to be replaced in the next year? For example, if your reserve study says that next year you should be replacing your pavement or replacing roofs, use it as a planning tool, because now then you can start planning by doing specifications for the roof, the roads, or whatever, so that you can do what the reserve study suggests. The reserve study money is meant to be spent. It's not meant to sit there forever. Just because you have a lot of money sitting in your reserve fund does not mean you're managing the community correctly. It means that, to me, the money's there to be spent. If you replace things, it maintains your community's property values by making sure you replace things when they need to be. For example, two communities right exactly the same right next to each other. One of them just replaced its roads, and the other one has 20-year-old roads that are cracking. Even though they have the money in the reserve account to do it, you drive through that community, where do you want to live? Brand new roads or one with crumbling roads? It maintains the property values in your community. The money is meant to be spent. It's meant to be spent. So what is anticipated next year? What happened in the past year? Let's say you replaced your roads or your roof. Then the reserve study should be updated, because then you can amortize the replacement life over a full useful life of that component, because it's brand new, and it may reduce your annual reserve requirements. So what happened in the past year? Did you replace anything? Does it need to be updated to reflect that? But you should look at that each year. Then the other thing is, if the reserve study you have and you agreed to says that you should be setting aside $100,000 a year, and let's say you're in New Jersey and there's a big snow in the winter, and because of that, you had to take money from your reserves for snow plowing. Take a look. Did your actual funding match the proposed funding? And if it didn't, what impact does it have? Because you may have to increase your funding and maybe update the study to see how it affects you going forward. But this is what you should look at each year. You don't need a reserve provider like me to answer these questions. How often should you update it? It depends on the funding plan you're using. If you're using baseline funding, I'd make the argument you should update it every year. Whether or not a component is replaced, let's say you add a new component, you add another tennis court. If you add another tennis court, the study should be updated to add it. And then the other thing, going back to what I said in the beginning, is now your community is going out 30 years. If it's been a few years, there might be some things that now need to be added because they fall within that 30-year window. How many of you have wood siding on your buildings? Wood siding. Wood siding, let's say that's useful life for 35 years, even if you maintain it properly. You should be adding that to your reserve study possibly at some point. Whether or not you've been funding to match the plan would be an update. So, general guidelines. Keep in mind, these are general guidelines, which mean they're general and they're not guidelines. For communities that are up to 5 years old, every 3 years, associations up to 10 years, every other year, and associations over 10 years old, some of them update it every year. Now, the question is, what type of update do they do, which I'll talk about in a second, but these are just some general guidelines. In the other webinar I have actually a flow chart that says, look at this, 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 and this, and it will help you determine how often to update it and what type of study to update it with. So general guidelines. What else should you do at update time? Now this is very important as communities get older. But after 5 years, you have somebody out there looking at the community, the common elements that are included in the reserve study. Take a look at the entire community, not just the components on the reserve study. If you have an update being done and you hire somebody and say, update the study that we have, what they're going to do is they're going to give you a price and they're going to update the old study and look at what's on that old study. They ain't looking at anything else unless you ask them to. So review the entire community. And this gets down to when you ask somebody to give you an update proposal, don't just say it should be in conformance with the national standards, because you miss things. I can only think of one management company, and we deal with a lot of them, one management company that actually puts out an RFP and says, we want a reserve study, and this is what we want you to include and we want you to do. Doesn't happen often. So after 5 years, possibly add components like I mentioned, give an overall evaluation of the existing conditions. For example, the standard reserve study, in my firm, we have standard reserve study. The standard reserve study matches the national standards. It gives what I showed you in the physical analysis. We also do, and I'm not sure if other people do, what we call the detailed reserve study, where we not only show what the estimated remaining life is, but we give a description of the condition and make suggestions based on the condition, not just putting a useful life on it. So give an overall evaluation. After 10 years, again, review the overall community, possibly add components, right? Same thing, add contingency for unanticipated replacements. And what happens is that there are a lot of things that you can't see. And there's history that starts coming into play. For example, let's say you have water lines that go to each individual home under the ground. They're generally not on the reserve study, but let's say you start historically having to spend $10,000 a year to replace them because they're falling apart. Based on that additional information, it should be included in the reserve study, but maybe adding contingency. CAI just recently came out with a brochure, and we'll send it to you. If Jeff's here, I'm sure he's got this all down. But a brochure on capital, on what happens to your infrastructure in communities. It's all about how when communities get older, there are unanticipated expenses that come up that should theoretically be accounted for in the reserve study, but they can't be seen, like riser pipes and high rises and things like that. So as communities get older, the suggestion is to add contingency for unanticipated replacements. You know, even if you take it to the next level, you know, some people recommend that as communities get older, you start doing, for example, moisture probes in your buildings to see if water's getting in and rotting out the building, things like that. So the older the community gets, the more involved you should get when you do an update. So stucco is another big one these days with us, that we're getting a lot of requests for evaluation of stucco on buildings because water gets behind it, it cracks and it starts rotting out in your buildings. So we're involved in a number of cases, do thermographic analysis to see if water is behind the stucco, but stucco is a common problem. You can't see what's going on behind it, but something is. Or ephes, you know, different facade types on buildings. Over time, they create problems, but you can't see it. All right. Now, once you get your reserve study, how do you review it? As a manager or as a board member, what do? Take a look at the component list. You know, you live there, you manage the community, you're on the board. You know, we may put on the reserve study, for example, street lights, not knowing that the street lights are maintained and replaced by the municipality that you live in. They're not a common element. So take a look at the components. I mean, it's a team effort to get this right. And the reserve provider really needs you to look at it and take a look at the components. Or if there's something that you think should be there because you're spending money replacing it every year, talk to them and maybe add it. I was talking about the contingency before. Very important. Like I said before, the component list can be wrong and the rest of the study can be right, but then the study is wrong. So the component list is the place to start. Take a look at the beginning balance. One of the things we have to have is what is the beginning balance because it affects the contributions. So most communities are on a fiscal year that matches the calendar year. So what we would need to know is to set the beginning balance that's anticipated at the point in time when the study becomes effective, which a lot of times is January 1st. So you may be doing the study for your budget in October or this time of year, but when we do the study, we need to know the beginning balance that's projected at the time it becomes effective, which generally matches your calendar year, fiscal year, and that's the number that would be in your budget, which would also reflect the contributions to reserves, which the study would be based on. So what's the beginning balance? You see the effective date of this study is very important. I was just working with one the other day and I was asking for this and I was saying this and they said, our fiscal year is a July end fiscal year, not a year end fiscal year. So, but most of them are year end fiscal years. Check the estimated remaining useful lives. The reason I say that is because you may know something. For example, let's say you have railroad tie retaining walls that are starting to rot away and we said replace them in 2 years because they'll live another 2 years. You may already be planning on replacing those retaining walls just because they're aesthetic value and you have a plan to do it already. So we really need your input so that this estimated useful life reflects things that you're planning on doing, not just based on our physical evaluation. And also this historical information, you know, sometimes you can't see that a railroad tie is rotting away from behind because you look at the front of it and it looks good. So if you have historical information, that should be taken into account in the estimated remaining useful life. Check the threshold and the funding plan. We talked a lot about that, but take a look at it to make sure it matches what you've come up with your provider. The other thing to keep in mind is that let's say you're underfunded. It doesn't mean you have to go immediately to a threshold. Let's say you want to say our threshold is $50,000. We never want to get below $50,000. But in order to do that, you need to increase your reserves annual contribution by 25%. If you meet with the provider, maybe you come up with a plan that says, let's increase it 5% a year for the next 10 years to get where we need to be, but it's not a jump to a 25% increase in your funding. That's again why it's important to meet with the provider. All right, meet with the person who prepared the study. This is a key. A lot of people don't do it. These days, it's very easy to do. Meet with the person who prepared the study. One of the things I suggest that very rare is done, ask your reserve provider to give you the study, just the numbers, not the report, just the numbers. Then meet with them, come up with what your plan is, then finalize the report based on what you come up with for the meeting. The other thing that can happen is if we're doing what we're doing now, for example, a Zoom meeting, we can actually have up on the screen the reserve schedule, and we can make adjustments to your annual contributions, and you can see what happens to the cash flow. You can see how close you come to a deficit and that type of thing, but meet with the person who did the study. A couple of advanced techniques. This is an example of just going through the process of what I just said. This is a graph where it shows, like I said, green, full funding, blue, baseline funding, red is what happens if you continue to fund it the way you're going. Does this jump out at you immediately and show that you're running into a deficit in a few years? It shows that you got a problem by just looking at this. So, Kipcon 2008. Oh my goodness, I'm getting old. All right, so this is, take a look at the funding plan. This just shows in this example, it did exactly what I was talking about. The association came out and said, they went through the whole process. It's too big a jump. How do we get there? So what they decided to do was, they said for year 2007, the first 14 years, they're going to increase their annual contributions by 4% a year, and they want a threshold of $50,000. So this sheet is the numbers behind the cash flow graph, which you get with the study. It shows how much is in the reserve fund balance, how much is your annual contribution. So in this case, they said, we never want to go below $50,000, but we don't want to increase our reserve contributions more than 4% a year. So by doing that, they got to a $50,000 contribution in about 14 years, but it was a gradual increase in how much was being set aside a year. So this is why a meeting with the provider is very important, because it really helps you get to a plan that works for you. So now I'm going to show you something that very few people do, although more and more people are looking at it. And what it is what we call here a green reserve study, where keep in mind, when you have a physical component of your community, I'm going to use a wood fence and the air conditioning system as the example. The wood fence, what do you have to do to maintain it? You have to paint it or stain it every 4 or 5 years, let's say, and then after 15, 20 years, you have to replace it. You have an air conditioning system. What do you have in addition to the air conditioning system? You have the cost of energy. The problem with reserve studies is they only talk about replacement cost and they don't talk about anything else. So I make the argument that the reserve study of the future is going to take into account not just the replacement cost, but also the maintenance cost and the energy cost, and really look at it from a life cycle basis, taking into account all the costs of the components. So looking at maintenance, energy, and replacement. So I'm going to give you an example of what could happen. And what we've actually done these for primarily high-rise buildings. Here's your original component list listing all the components. This is the original cash flow. What's your projection? This is what it looks like. We've gone through all this. Now, this example, if you go in this example from full funding, which I say is overfunding, in this case, $190,000 a year, to baseline funding, $157,000, that's a $33,000 difference per year. So over 30 years, just by changing your funding plan, you can reduce your contributions by close to $1 million. Now, again, keep in mind, I don't recommend baseline funding, but this just gives you an example of what can happen just by changing your funding plan. So that's one place to look. Now let's look at the entire picture. For each of the components in black here, we've added the cost per year of maintenance and the cost per year of energy, and we've come up with what is the total cost of those components, not just the replacement cost. So we've added those. Those are in red. Now you'll see that the projections over 30 years, instead of being $5 million over 30 years, maybe it's $10 million over 30 years when you add all these things together. So now what do? We substitute for the wood fence and vinyl fence. The vinyl fence now has a 30-year life or a 40-year life. It never has to be replaced. And so theoretically, it never has to be replaced. So it may even come off your reserve study if you put in a vinyl fence instead of the wood. You don't have to paint it every 6 or 7 years. And you don't have to replace it for 40 years if you ever even have to replace it. So change it to a vinyl fence. The concern people have is they say, okay, well, the vinyl fence is going to cost more. Where am I going to get the money? In most cases, your threshold in your fund has a lot of money in it. So you take the money right out of there, and within a few years, you break even and you're always saving a lot more money. So now let's say we take an air conditioning system that instead of costing, it has a useful life of 15 years, the new one costs more, but your energy cost, instead of being $50,000 a year, goes down to $30,000 because you have energy efficient air conditioning system. So you add these things together and you look at everything together. And in this case, your 30-year savings just by changing the components, even though they cost more, in this case is $700,000. So I make the argument all the time is if you do a reserve study update based on the standards, here's what's happening. The provider is looking at the old study, updating the study to reflect, first of all, only what's on that study. So we're not adding things. I got 3 minutes. Only you're not adding things. And the other thing is they're replacing them with what's there now or something similar. The standards do not say, look at it to incorporate any possible life cycle savings in terms of changing what you're replacing with. Another common one is a wood retaining wall. Wood retaining walls always have to be replaced. But you replace them with a block retaining wall, it's going to cost more, but it comes off the reserve study because you never have to replace it. So really, these are some advanced techniques. I think that in the future, more and more reserve studies are going to use this. I'll tell you, I gave this seminar a few weeks ago, and we had a proposal out to somebody to do a reserve study for them. They said, Mitch, listen to your presentation, change your proposal to match what you talked about. And so one of the things you consider is when you ask an engineer for reserve study, most people say, give me a reserve study in conformance with the national standards. National standards are a standard like a building code. It's the minimum requirements. Ask for additional things like this. They don't cost that much more to do, and they can save you a huge amount of money over time. This is the classic way of doing it. Material and labor for total cost. You decide how much, what you're going to do. If you had a wood fence here and a vinyl fence here, you're going with a wood fence because it's going to cost you a lot less than a first cost basis. But whenever you do replacements now, based on, add to it either the maintenance cost or the energy cost, and I promise you your decisions will change. Now, one thing I'll mention, if you want to write this down, there's a website, and it might be in here later, but it's dsireusa.org. And the reason I mention that, I can pull it up on the screen if you want me to, is, there are so many incentives out there to replace standard air conditioning systems, let's say with high efficiency energy air conditioning system. There are so many incentives available out there. This website will give you a map of the United States. You click on any state and it gives you a list of every incentive that's offered. And if there's any incentive you're interested in, you click on that incentive and it'll take you to where you go to apply for it. So it's dsireusa.org. It's a great website because when I look at this evaluated cost approach, add to the bottom here incentives that you can get for mechanical equipment. And I've never seen an incentive that says you've been collecting money for replacing this air conditioning unit, so you have to give us some of that money if you get this incentive. In some cases, you can actually make money by getting incentives since you've accumulated the money anyway. So once you get this information, let's say it says replace your air conditioning system in 3 years with a high efficiency air conditioning unit. You may decide to replace it now because the break-even period is 3 years and you don't want to replace and wait until the future to do it. This is just an example of an air conditioning system, HVAC. It's essentially what I just said. In this case, by going high efficiency, even though it costs more, you're saving $362,000. So just an example, how do you select somebody to do your reserve study? CAI has this national designation. It's called the RS, the Reserve Specialist. It's based on education, experience, references, and also in a lot of cases, the RSs are engineers. But at a minimum, when you're asking somebody for a reserve study proposal, it should say that the firm has to have an RS on staff. That means that the study is going to be done in conformance with the national standards, not above their national standards, but in conformance with them. And that's it. So I'm going to, let's see, how do I unshare? I'm going to unshare this and open it up to any questions anybody might have that I'd be, oh, how do I unshare? Let's see, I want to go to, oh, here you stop share, that'll do it. All right, so now I'm not sharing. And what I'd like to do is, I think I can unmute everybody. All right, well, if anybody has any questions, now is the time to do it. I see that we do have pretty good participation. A lot of people still want to be hidden these days. Let's see, can I comment on shelf life? I answered that. Oh, the website address is dsireusa.org. And I can actually, are there any other questions while I'm going to, dsireusa.org. Any other questions? I see, Peter, yes.
When you were talking about estimating replacement cost, I noticed that was in current year dollars. How do you think about inflation if you're budgeting an item that's 10, 15, 20 years out?
Great question. Great question. As a matter of fact, great question. Generally, they're done based on present dollars. And the reason it's done by present dollars is because, first of all, we're not economic forecasters, but if the community says to us, add 3% interest and 3% inflation, we can do that. But what happens is that the inflation is based on the replacement cost. The interest is based on how much money you've accumulated so far. So what happens is that it increases significantly the replacement costs in the future, like 3% a year or whatever the number is, but the amount that you're collecting in interest doesn't come anywhere close to offsetting it. Now the question is, well, maybe you should anyway. So what I did was, and I'd be happy to share it if anybody wants it, is I did a side-by-side comparison where it's in a spreadsheet where I said, okay, let's say that we're going to increase it the way I just said, 3%, and do a cash flow exactly that way, versus updating your study every 3 years. And at that time, then you add the amount that's in the beginning balance, assuming that you've been collecting that interest. And at that time, you use the present dollars. And I did a side-by-side comparison about how you end up after 30 years. And it's pretty close because it's pretty close because first of all, you're making the assumption that when somebody has an amount of money in their fund, the interest they accumulate in that fund, they're keeping in the fund. Some people do it, some people don't do it. But I did a side-by-side comparison and it shows that it's a real jump if you do it once versus a gradual increase over time, and it comes out about the same. But it's a great question. And if anybody wants that, wants to see that side by side, I'd be happy to share it. Just ask us for it. I'm going to show you this because you can tell that I really like this website. This is dsireusa.org. Now you go to the map, and for any state, and what state you want, I'll pick Florida. You go to Florida. And now what's going to happen is, if it's working, it's going to show, why isn't it doing it? Oh, it says policies and incentives. There's 72 of them. For some reason my thing isn't working because usually what happens is every one of those incentives pops up and All right, let's try by zip code. 08902. That's a New Jersey zip code. Search. Okay. Now, for some reason it works by zip code. This is a New Jersey zip code. Now, what happens is every one of the incentives in the state of New Jersey pops up. Now, let's go to PSE&G Solar Loan Program. Now, go there, and it takes you to a description of what it is, the program overview, and a summary, and then it shows you here, website to get to it. So that's why I think that's, before forgetting about your reserve study, whether it's in your home or it's in your community, before you replace anything that uses any kind of energy, go to this website, because in some states there are incentives for just about everything. For example, New Jersey has some great programs, pay for performance and a few things. You can see in Florida, there's 72 of them. So it's a great website. Anyone else have any questions? So I answered every question, huh? All right. Well, everybody have a great day. I really appreciate it. If you're interested in us doing the other webinar on reserve studies, the more advanced one, we'd be happy to do it. Just emailing me, let us know, or Jeff or Jenny. Obviously, not that this is meant to be educational, but not as much sales. If you ever want a proposal, we'd be happy to give you a proposal for reserve study or any other kind of engineering. And if you are looking for continuing education units as a manager, just email us, say you attended, and we'll send you a certificate that's good for the continuing education units. So thank you very much, everybody, for attending. Have a great day. Be safe. It's a little crazy out there. And we'll talk to you soon.